Disclaimer. The information presented in this video does not constitute in any form or shape neither business advice nor accurate representation of tax legislation. It is not intended either to be relied upon or based on business decisions. It is general information intended to help UK minicab drivers. It is important to consult your tax advisor or accountant. Use at your own risk. We accept no liability for any inaccuracies, incomplete information contained in this video, or any loss incurred by its use. Today we'll be discussing a topic which is quite a large area of concern for many minicab drivers, and because it's such a daunting topic for many of you watching, we shall slice it up into small question-based digestible sizes. Can I deduct the cost of acquiring the car as a business expense? To answer this question, I must first take you through the wonderful world of expenditure. What is expenditure, I hear you asking? Expenditure is just a fancy word for how much you spend, and there are actually two different types: revenue expenditure and capital expenditure. It is very important that you know the difference between these two types. However, it is important to know that the distinction between capital expenditure and revenue expenditure is not always clear-cut. Capital expenditure is a balance sheet item and usually a disallowed expense, but may attract capital allowance. Capital allowance is a form of depreciation allowance for tax purposes. Capital allowance gives a business tax relief for capital expenditure for qualifying assets over the life of those assets. However, rental and lease charges payable in respect of the leased cars is an allowable expense where CO2 emissions of the car is 110 kg or less. Where it exceeds 1,010 grams per kilometer, 15% of the rental or lease charges are disallowed. To reconfirm, capital expenditure is disallowable, whilst revenue expenditure is allowable. Hire purchase agreements and leases. In order to decide whether the capital expenditure is revenue or capital expenditure, we need to look at whether the car's ownership passes or not. The hire purchase agreement. While ownership remains with the financial house, the buyer has the option to obtain ownership by paying a final installment. HPAS are regulated by Consumer Credit Act 1974. If the sole trader, as a minicab driver, buys the car through a hire purchase agreement, then the expenditure is in the capital nature and attracts the capital allowance and cannot be deducted as a revenue expense. Hire agreement. Hire agreement is different from the hire purchase agreement in the sense that the hirer only obtains usage possession and ownership will not pass to the hirer. In some situations, it is regulated by the Consumer Credit Act of 1974. This is a revenue expenditure and the cost can be deducted. It will not attract any capital allowance and cannot be capitalized in the balance sheet. Leases. Lease is a contract between the lessor, financial company, and the lessee, the minicab driver. The minicab driver, the lessee, pays the owner, the lessor, rental payments as specified in the lease contract. At the end of the lease, the car is returned to the owner, the lessor. However, if the lessor sells the car to the minicab driver at the end of the lease, the contract may be construed as a hire purchase agreement, making the expenditure capital expenditure and therefore be subject to the legislation on hire purchase. There are two types of leases. Operating lease. An operating lease is hired on a short period and is revenue expenditure. It is not capitalized in the balance sheet and does not attract capital allowance. Financial lease. In the financial lease, the car is leased to only one user, which retains the possession of the car substantially throughout the whole of its working life. The asset will appear on the balance sheet together with the finance company's creditor. The finance charge of the lease can be deducted as expense in the profit or loss. Conclusion on car expenditure. Hire purchase agreement is capital expenditure, attracts capital allowance, and so you can deduct financial interest charges as expense. Moreover, the finance lease may be capital expenditure, ownership passes to the lessee, lessee may have the option to buy lower price than the fair value, the lease term is a major part of the asset's economical life, even if the ownership isn't passed. Installments are all of fair value of the leased asset. The costs are added to the amount recognized as an asset. Furthermore, the operational lease is not capital expenditure because the risks and reward of the ownership do not pass to the leasee. The lease is classified as an operating lease. Rentals are charged to the profit or loss accounts. It's revenue expenditure that can be deducted as a business expense. While the hire purchase agreement is clear where it stands on the thin line between capital expenditure and revenue expenditure, the financial lease is not. The best example for this case is the case of Waterloo Car Hire v. HMRC TC 5479. In this court case, a minicab driver who rented a car from a minicab operator for 4 or 5 years, the operator then sold the car to the minicab driver once the car ceased to have any economical value. It was decided that the fixed assets subject to capital allowance legislation should not be included in the cost of sales, which the taxpayer included in his tax return of 2011 to 2012 as a revenue expense. He later appealed. The appeal was dismissed. Although this was the operator's classification of the asset, the question for the minicab driver relates to the exclusive use, which makes rent payments as mere installments. This case presents the thin line minicab drivers walk on, and so one must be careful. Thus, operating leases are the safest route for minicab drivers. With operating leases, the hirer may not have exclusive use of the car. Once the short-term lease agreement finishes, the lessor rents the car to another renter, and the risks and rewards remain with the lessor. This is a revenue expense which can be deducted from the profit as a business expense. The changes. From 1st of January 2020, how leases are reported changed. All leases, finance or operating, will be capitalized on the balance sheet except those which are less than 1 year. Finally, we can now go on to revenue expenditure. In revenue expenditure, the taxpayer had to show that expenses were wholly and exclusively incurred for the purpose of his trade as a minicab driver. As we have discussed, expenditure on capital assets is not an allowable trading expense. For minicab drivers, the capital assets may be things like a car and smartphone. So what is an allowable expense? Repairs are allowable expenses. Rental and lease charges payable in respect of the leased motor cars are allowable where CO2 was 110 grams per kilometer or less. PCO costs for the driver and car are allowable expenses. Petrol, car wash, mobile phone, running costs, accountancy fee, car insurance, MOT, road tax are allowed but adjusted for any private use. Warranties are allowed, calculated under UK GAAP. What are not allowable expenses are: fines are not allowable business expenses. Eating out lunch is not an allowable business expense. Suit is not an allowable business expense for minicab drivers. All these expenses fail to pass remoteness and duality principle, which we shall delve into in an upcoming video. However, if the expenses are incurred for both business and private and can be separately identified, a deduction can be made for the business proportion. However, as a minicab driver, your expenses are limited to a set list. However, it is important to note, the taxpayer had to show the expenses were wholly and exclusively incurred for the purpose of his trade as a minicab driver. Thanks for watching the video, and stay safe.